I worked in a bank for maybe 10 years, and they just gave me the money to lend. I didn't have to think where it came from, and I had to run a model and check a few numbers. But broadly speaking, as long as the risk was correct, you could lend. I think the biggest thing that we all are incumbent upon us now is to understand a bit more detail about banks and capital, because we talk about this thing about banks' capital, but what does it actually mean, and why is it important? There are some key dates, and there's some very important ratios that matter. The key dates are 2015, actually 2014, and I'll come back to that in a second. 2015, which is Basel 2.5, which is you've got to be, as a bank, you've got to have progressed far enough along the line of the new Basel regime. And then arguably 2018, when you're meant to be Basel III compliant. The compliance is in two different ways. One is you've got to hit a ratio of capital versus your lending book. And the way you describe that is risk-weighted assets, which doesn't mean if I lend 100, my risk-weighted assets are 100. If that loan is 40% loan to value, my risk-weighted assets might only be 20. So it's biased towards risk-weighted assets. And you're meant to be, as a bank, ideally in double-digit ratios now. The other ratio that's super important and no one ever talks about is the leverage ratio. And that's to do with people like UBS, who had lots and lots of AAA-rated bonds that attached no capital but were monstrously huge in volume. And then when the party stopped on subprime, people went, oh, these aren't AAA-rated, and actually we have an issue. So the leverage ratio is saying is that irrespective of capital, you can't leverage your balance sheet more than arguably 30 times, ideally lower. These are important because most banks in Europe still don't meet these ratios. And a couple of things have saved them. One is, if they'd actually tried to meet them or mark their books to the right places, they'd all be bankrupt, so there was a conspiracy of silence. Then there was no liquidity. You couldn't actually raise money in the markets for bank liquidity, so you couldn't shift stuff or move stuff anyway. I think what's happening now is you've got a really interesting moment in time where you have a capacity to do things now. There is liquidity, there is high yield, there is corporate bonds, there is lots of ways for banks to create money for themselves. But also you've got an improving P&L of the banks. But then you've got some really key dates. The first thing that's happening is in September of this year, the ECB takes over as regulator for the banking system in Europe. And before that, they're undertaking what's called the Asset Quality Review. You might have heard that earlier today. And the AQR is a really big thing because it's basically a moment in time that allows the executives of the banks to be honest. And the ECB is saying is if you're not honest, you're in deep trouble afterwards. And the AQR is frightening a lot of bankers because they have to get the books marked properly as much as they can. And so the AQR is one of the impetuses is what you're seeing now, which is massively increased amount of loans being sold off at the moment because they've got to meet that deadline. And then the key date for 2015 with 2.5 is to do with the fact that they have to have the right kind of capital. And a lot of banks have what's called hybrid capital, which is really debt. It's not really equity, it's debt. And a lot of banks, particularly German banks, have a lot of hybrid capital that has to be converted into real capital. So you've got a couple of things all happening right now, an improving world, ability to do things, and some pretty tough dates coming up. And that's, I think, what's creating the interest and the real change in the dynamics of what's going on.